topic. So as these are revision sessions, the format is going to be at quite a reasonable pace. As I said, we've got 45 minutes. Now, we're not going to rush through the content, but we're going to make sure that we get through everything we need to, just in anticipation of the people that are going to be watching this afterwards. Now, as this is a revision session, we're going into this with the mindset that you have some previous understanding of the topics that we're covering. This isn't a tutorial, so we aren't going to be looking at these from scratch. So, for example, for depreciation, when we're using terminology such as the carrying amount, residual value, we are going to have a sort of a preconceptual knowledge. We're using this just to really consolidate, to reinforce what you've learned, and hopefully just pick up a couple of tips which may serve you, be really useful for you in your revision moving forwards and in your live exams. So we're going to move straight in, like I said, and we're going to basically very quickly recap why we actually depreciate. Now, at this point, again, I'm relatively confident you'll be quite sure about this. It's pretty well known over the period of time. The value of our assets, be whatever, be a vehicle, a machine, office equipment, the value will naturally decrease over time. Now, this can be for a multitude of reasons. It can be for its age, its overall usage. Think, for example, with a car, the more mileage we put on the car, the more the value of that car is going to drop. So because of that, when we first record the acquisition of an asset, we record its full amount. However, let's fast forward, move 5 years down the line. We know that that car is not going to be worth the same. It's as simple as that. So because of that, we need to make sure what we do is very, very simply make sure that there is a fair reflection of the value of the asset within the book, or within our books, I should say. So we're going to have a quick look at the three methods of depreciation, which at this point you'll be very familiar. We have the straight line basis method, the diminishing balance method, and then the units of output method. So we're going to have a quick look at the sort of individual characteristics of all three. We're then just going to revisit the formulas, just pick up a couple of tips just to make sure we're not getting tripped up and making sort of very easy mistakes to make in the exam. And then we're just going to have a look at how we apply pro rata. And then we're going to have a quick look at a couple of practice questions. So we're going to jump straight in and look at straight line basis. Now, straight line basis is in essence the most commonly used method of depreciation. It's the one which individuals that work in practice or have sort of had experience dealing with this in the working world before, this is the one that generally people tend to use. Now, with this method, the total amount, which is going to be our annual depreciation charge, is essentially charged in equal installments. And when we talk about accounting periods, we simply mean, in this instance, a financial year. So this means that over the lifetime of a value, we're going to charge the same depreciation charge every year, meaning that our carrying amount is going to decline at a steady rate or in a straight line, as the name suggests. So this method is most suitable for assets which are used up evenly over their useful life. Now, when we say most suitable, when we talk about depreciation in terms of your advanced bookkeeping exam, you won't be asked to recommend a certain method of depreciation. So we are saying that it is most suitable in this instance, but it is not the only one that you can use. The sort of questions you'll be asked in your exam, don't focus on that. You'll be more concerned with actually calculating it and then doing double entry afterwards. Just looking, Sarah, we are going to be covering the accruals concept in the later one. At the end of this session, we have put a schedule together for you guys, so I'll share that for everybody so you can see the sort of plan between our sessions between now and the 1st of March. So tonight, as I just said, it's depreciation, and then we're going to be doing markup and margin, as Carolyn has very kindly pointed out. But like I said, I'll get the schedule up for you guys in a little bit. So in terms of straight line basis, the formulas, which again, at this point, you have probably had plenty of practice with these before. You should be relatively familiar with them. So basically two different ways. The first one, which is probably the more common one you'll be used to, is your cost minus your residual figure or residual value. And that will be divided by the asset's useful life, or as it is more commonly known, its useful economic life. That is the term that you're probably going to see in your exam. Now, the thing you want to watch out for when you're using straight line depreciation is when there is a percentage applied to it. A very easy mistake to make, which I have seen happen so many times, is an individual will read the question, they'll see depreciation and they'll see a percentage figure and they automatically assume it's the diminishing balance method. We can use the straight line basis method when we apply a flat percentage. So for example, 20% per year. It's a very easy mistake to make, and it's an age-old anecdote, and you will probably heard it 1,000,001 times. It's in essence the importance of reading the question. Don't fall into the misconception of seeing a percentage thinking, oh, it must be a diminishing balance. Oh, your speaker is not working properly. I apologise. Okay, guys, let me just get that up. I do apologise. It appears my audio was just cut out. Just bear with me 1 second, guys, while I get that sorted. Let's have a look. Okay, I think we're back. Apologies about that. We seem to have some headset issues there. My apologies. Okay, so where were we? Depreciation, straight line basis. Okay, so as we said with the formulas, priority is ensuring that if we do see a percentage figure, we do not get our hands tied and automatically associate it with the next method, which is the diminishing balance method. So your diminishing balance method calculates the annual depreciation charged as a fixed percentage of the carrying amount. So in terms of that, what we simply mean is fundamentally, we are going to charge in our initial year, let's just get, for the sake of the example, we use 20%. We're going to charge 20% on our capitalization. And then, of course, we are left with the carrying amount. And then in the following year, we will charge another 20% on the carrying amount. So obviously, the primary difference between the two methods in this instance is this one is used when it's thought that the benefits obtained from using the asset decline more over time. And again, it's best used, not mandatory. You won't be asked to recommend these come your live exam. So a very good example is a machine where the productivity, or basically its overall efficiency, falls as the machine gets older. And again, maybe older because of its usage or just through the laws of time passing on, plain and simply. And for your formula, now depreciation for the diminishing balance is relatively simple. But again, there's just one thing we do want to watch out for. So we've been told it's our depreciation rate, which is the percentage. Now, this will always be given to you in the exam, which is another important point to mention. You will always be presented with that percentage rate. You won't be expected to sort of pluck it out of thin air. It will be given to you. And in this instance, we will simply times that by the carrying amount. Now, the key difference here between diminishing balance and straight line basis is that the diminishing balance does not take into account the residual value. So when we're using this method, if we are told about the residual value in a question, ignore it. It is not relevant. We are purely focusing on the depreciation rate percentage times that by our carrying amount. Again, a very common slip up that people make, so do keep an eye out for that. It's where you can drop really, really easy and important marks in these exams. It's much better to sort of spot the mistake and make it now, as opposed to making it in a live exam. And then the last method, units of output. Now, units of output it's a funny method. In truth, it's slowly but surely on its way out. It is not commonly used, and it is not commonly seen in the AAT questions. So, for example, if you access your learning portal on the AAT and you sort of do the e-learning on depreciation or take the green light tests on depreciation, there isn't really any questions on units of output. It is a dated method, and truth be told, it is slowly but surely exiting sort of accounts as a whole, because it is just a dated method. It's not particularly prudent or useful, but ultimately we are still expected to know about it at this moment in time. And although it isn't a likelihood, it can appear in your exam. It's important to remember it can still appear in the exam. So knowledge of this one is really important. Sort of backtracking to a few years ago when I sat this exam, I made the mistake of focusing really heavily on straight line basis and diminishing balance. And then as luck would have it, the one question that came up, of course, was depreciation unit using units of output. It can come up. So don't discredit it. Don't think it's not as important. You know, it's give yourself the best chances possible. So as we just said, so it involves charging depreciation according to the actual usage of the asset. So when we talk about the units of output, the clue is in the name. We're charging depreciation based on how productive that thing is. So for example, if we're talking about a car, if we're talking about mileage placed on the car, if we're talking about a machine, we're talking about the amount of units that it is produced. So the life of the asset is measured in terms of the number of units it is likely to produce or hours used. It is then depreciated according to that rate. So in this method, a higher depreciation is charged when there is greater activity and less when there is lower usage. So again, the more we use the asset, the more depreciation we are going to charge in that year. And then again, the less we use the asset, the relevant depreciation charge will be lower. And your formula for this one is a bit more long-winded, but it's relatively straightforward. Your number of units produced in the year divided by life in number of units. Now, when we use that term, we simply mean how many units we are anticipating that asset will use. So, for example, if we have just bought a machine, if we anticipate that it will produce 10,000 units in a year, that is what our life in number of units, 10,000 units over its lifetime, not the year. That is the life in number of units that we'll be focusing on. And then we're going to simply multiply that figure against the sum, which will be the cost less your residual value. So this is the one which, like I said, it's really not covered, but it can come up. So I encourage you to take reference of the formula. Okay, no volume. Okay, guys, can you hear me now? Yeah, okay, apologies about that. That's very strange. I think I've got one too many wires plugged into the laptop. It doesn't seem to like it. So I do apologise about that. Thank you for letting me know. Oh, that's unfortunate. Okay, no problem. So, yeah, I'll just sort of backtrack then very, very quickly. Very loud. Oh, dear. Okay. Let's have a look. Okay. How's that, guys? Is that any better? Yeah, that's better. Okay. No problem. Thank you for your patience. It's the joys of technology. If it does go a bit too loud or go a bit too quiet, please just let me know. I do promise you, this is the one time in my entire time I've been here that my headset has now decided to throw a bit of a funny one. So I do apologise. Thank you for letting me know. If it does sort of go a bit on and off again, please just let me know. I'll get sorted for you. So yes, I'll just backtrack very quickly. So we're talking about the number of units produced divided by the life in number of units, which is essentially the amount of units that we are anticipating this asset will make over its entire life. And we're going to multiply that by a figure which is our cost less our residual value. Okay, so before we sort of go any further, we're just going to make a quick point about looking at pro rata. And again, we're going to make reference to the dates on here because, again, a very common mistake people make is they have absolute fine and understanding of depreciation. They can work out the calculations, but then when it comes to actually applying pro rata, the dates are essentially what throws them off. So before I sort of go into this, what I'd like to do is I'm going to pose a question to you guys very, very shortly. And in that time, I'm going to give you a couple of minutes to have a look at it. And it's very convenient timing because it'll give me a second to sort my audio out for you. So as we know with pro rata, we are essentially going one of two ways with depreciation. And you will be given one of these two scenarios in your exam. You will be told that a company charges a full year's worth of depreciation in the year of acquisition, or you will be told that depreciation is calculated on a pro rata basis for the number of months it was held. So that essentially means when we bought it up until the end of the financial year. So a business bought a machine for £10,000 on the 1st of October 2019. It charges straight line depreciation on a pro rata basis of 20% and has a year end of the 31st of December. So what I'd like to know from you guys, and I'll give you a couple of minutes to do it just so I can get my headset hopefully sorted out, is what the depreciation charge for the year ended the 31st of December 2019 is. So I'll give you a couple of minutes. Once you've got the answer, please put it in the chat and then we'll run through it together. We've got a very good set of answers there. So 500 is the correct answer. We're going to have a quick run through it. So I'm getting a blank screen. Okay, so essentially what we're going to do here is break this up into different components. So the first step that we're going to do is, as people are already alluding to in the chat, is great. It's just revisit the information. So we've been told £10,000 and that we're calculating depreciation on a straight line basis at 20%. We're also told that the financial year end is the 31st of December 2019. So what we need to do, first of all, is to calculate just the annual depreciation charge. Now in this instance, it's relatively straightforward. We have our figure of £10,000. We're then going to times that by 20%. Now again, how you do that is up to you. There are many different methods. I won't sort of run through every single one. And that should give us a figure of what, please? £2,000. Thank you, Nelly. So yeah, so we are now told that that would give us a depreciation charge of £2,000. Now, if we were just depreciating, and then we were going to allocate this over the entire year, that is as far as we'd go. Now, what we need to do, however, is now make sure that we break this down into its monthly component and then assign those monthly components to the relevant amount of months. So the second thing that we're going to need to do is break it down into its 12 monthly installments. So it's going to be £2,000. And we're going to break that down into 12, which equals what, please? Yep, 167, or there or thereabouts. So when you are doing this calculation, as you'll see in a minute, you want to do it all at once. So I'm going to put 167 just for clarity, and then you'll see when we put all this in the calculator at the end together, it all ties together. So now this is where people sometimes get thrown off a little bit. So the important thing is to make sure that we actually know how many months we are working with. And the clue to do that is in the date. The greatest mistake that you can make is see a month. So for example, October, and instantly go, okay, October to December, October, November, December, 3 months. In this instance, that is what we're doing. However, as you'll see in a minute, I'll show you how by just distinguishing between the date specifically given to you, where these questions go right and wrong. So in this instance, we are correct. So overall, we're going to do £2,000. We're going to divide that by 12, and we're going to then times that by 3, which will give you your answer of £500. So in this instance, we are correct. If we go back, we'll see that the key question here, or the key piece of information, which is really important on pro rata, is this bit here, and that is the date that we are given. So we are told on the 1st of October. The biggest mistake that people make in these exams is, like I said, seeing the date and automatically assuming that they include that month. When you are doing these sort of questions, you will be given one of two dates. You'll be told it is either the start of the month or the end of the month. So as we have just touched on there, if we were using the 1st of October to the end of December, we're going to use all 3 months. However, if you are told that the date it was purchased on was at the end of the month, so for example, the 31st of October, we're using 2 months. Do not get mixed up just because you have seen the month of October. If this was purchased on the last day in October, we cannot depreciate based on the month of October. It doesn't make any sense. So the clue is in the date given to you. This is a really easy mistake to make. It's a very common pitfall people fall for. Check the date. You will only ever be given in these exams either a date at the start of a month or a date at the end of the month. You'll never be given anything in between. So you don't have to sort of worry about that. At this instance, like I said, if it's the 1st, we include the month. If it's the 31st, we exclude that month. So as we can see here, if we had purchased this on the 31st of October, we would then be looking at including only November and December. That's a very common pitfall in truth. So what I'd like to do now is I'm just going to pull up a couple of questions just so we can look at some of the methods of depreciation and then talk about just a couple of other key points that we really want to pick out for you guys. So let me just pull this up for you. Okay, so can everybody now see the document entitled Depreciation Practice? Yes, okay, wonderful. Fantastic. So we're going to move these relatively quickly because I'm conscious of the time. We have lost a bit of time to sound delays, so if this does overrun a little bit, I do apologise, but it's just the trials and tribulations of online tutoring sometimes. So what I'd like you guys to do again is just, we're going to have a look at a couple of questions in this instance, and there's a couple of points that we're going to point out sort of as we're working through them. So what I'd like you to do first is take a look at question 1. I will read it out for you, and then I'm going to let you have a go at it. I just want to see, before I start sort of throwing out information, just see what people's initial answers are. So Abbey Limited purchases a piece of machinery for £12,000. In addition to this, it pays £1,000 for installation and £2,000 for a 3-year maintenance plan. The machinery is to be depreciated using a 25% diminishing balance method, and the residual balance is expected to be £1,000. If a full year of depreciation is charged in the year of acquisition, what is the depreciation charge in the first year? So I will give you guys a couple of minutes to have a go at it, see what you think. Please just have a swing at it. If you feel like you aren't sure, give us your best guess. It's all part of the process. So I'll give you a couple of minutes, and then when you put your answers in the chat, I can see Nelly is flying ahead. So that's great, very good to see. But just have a go, guys, and then put your answers in the chat. Okay, that's great. So I can see we're getting a pretty common answer coming out here. There's a couple of different ones along the way. The general consensus appears to be 3,250, which is correct. Now, we're just going to have a quick look at the question, break it down into some individual chunks. I can see the majority have got it right, which is fantastic. Ultimately, there's a couple of things that are worth pointing out in this question. That is, we've been told that we paid £12,000, but we've now also been given some additional figures. So, for example, we've been told that we are paying £1,000 for installation, and then we're paying another £2,000 for a 3-year maintenance plan. So this isn't too dissimilar from the sort of question you might get in an exam. And ultimately what this is about is making sure that you can distinguish between what you will include in the capitalisation amount. Now, so that capitalisation amount, just in case you sort of need reminding, is the amount of value we will record the asset at, and what we won't include. So in this instance, we are going to include the £1,000 that we've paid for installation. We are not going to include the 3-year maintenance plan. I can see that people have picked up on that, which is fantastic. So can anybody sort of hazard a guess before I shout out the answer as to why we've done it that way? Why have we included the £1,000, but then we've elected to ignore the £2,000? Can anybody tell me why? I'll put the cat amongst the pigeons, won't it? Yeah, excellent, brilliant. So yeah, I can see there we've got terms like capital expenditure, revenue expenditure, which is beyond. So Sarah makes a very good point. We're talking about the 3-year maintenance plan. It's an ongoing cost. So ultimately, a rule of thumb that I was always taught at Masters, which served me very well, is when we're talking about the capitalisation amount, we want to include the value of the asset along with any costs to get that asset installed, and in working order. So that includes items like installation and delivery. So once we've figured out the capitalisation amount, the rest of the maths is pretty comfortable for us guys, as I can see. We're basically working out 25%. Again, you will do that in a method that works specifically for you. Yeah, that's really, really good, guys. Okay, I'm going to move on to question 2 quickly. So John Bella has purchased a piece of machinery for £30,000. This figure includes both non-reclaimable VAT of £5,000 and delivery of £500. The machine is to be depreciated over 10 years using the straight line method, after which it is expected to be sold for scrap for £2,000. If a full year of depreciation is charged in the year of acquisition, what is the depreciation charge in the first year? Okay, so I'll give you a few minutes, a minute again, just to have a quick look at it. Okay, brilliant. I can see answers coming in already. That's great. Okay, brilliant. So yeah, as a lot of people sort of picked up on already, which is fantastic, the answer is £2,800. So again, let's just quickly pick through the bones of this question, figure out what we're actually supposed to be doing. So ultimately, we need to first distinguish what method we're going to use, which of course in this instance is the straight line method. And then again, we've been told that we've purchased the machinery for £30,000, but we've been given another couple of figures. So we've been told that we have non-reclaimable VAT of £5,000 and a delivery of £500. So the question I'd like to ask you guys now is, we've looked at the last question where we've added a cost on. So why have we not added these costs on? Fantastic. Already included. The figure includes. The really important factor is, as we've been told, the clue is in the question. So in this instance, we've been told the figure includes these amounts, as opposed to question 1, where we've been told in addition to this. And again, it's the finer points like that which really do make a big difference in these exams. It's really, really easy marks to drop. So in this instance, we've also got the VAT figure that we need to consider. Now, traditionally, you wouldn't include the VAT, as it wouldn't be capitalised, because we could, of course, reclaim that as input tax. However, in this instance, we are told that it is non-reclaimable VAT. As Sarah has very kindly pointed out in the chat, if you cannot claim back the VAT, it should be capitalised and included in the amount that we depreciate. Okay, that's absolutely fantastic, guys. Great work. I am going to have to move on. Like I said, this will be we will sort of send this out. So just to make sure that you guys can have a proper chance to have a look at it. Like I said, I just want to make sure we get through all the content. So I'm going to pull the PowerPoint back up very quickly. Okay, PowerPoint is back up. So can please just check everybody can see this again, please, before we move on. Yeah, perfect, fantastic. I'm normally not this paranoid about the technology. However, we've just it's just I'm very untrustworthy after the issue of the teething problems I've had with it today. Okay, fantastic. Okay, so let's go straight down to the correct slide. Okay, so we're just going to take a very quick look at actually recording the depreciation in terms of the appropriate double entry that we're going to use. Now, again, we're not going to use figures at this point. We're just going to have a very, very quick look just at the general recording. So a really good rule of thumb, which I sort of like to tell people, is essentially what I call the double D rule, which is very memorable for various reasons. So essentially, when we're recording depreciation, it's important that we distinguish between the two accounts. Again, a very common mistake to make is that we get mixed up between the depreciation account and then the accumulated depreciation account. So every time we record a depreciation charge, we are going to debit our depreciation account, and then we are going to credit the accumulated depreciation account. So the double D rule, which is very simple to remember, is debit depreciation. And then simply by the laws of double entry, we know that the corresponding credit entry has to be in the accumulated depreciation account. Again, it's probably bread and butter to some of you guys now, but again, it's very common mistake to make. And it's also important to mention that when we are recording these entries, these are not going into the original non-current asset account. We always record accumulated depreciation separately. And when you guys are working on statements of financial position, you will see that it is visible. It has its own section. Now, the reason for this is essentially just to keep clarity in the information. So if we think of a large company that has so many assets, if we included accumulated depreciation in the original value, it would be pretty much impossible to keep an accurate record of what the value of certain things were when we originally bought them. Is there a fair reflection on the values now? So we always keep accumulated depreciation separate. Okay, I'm going to move straight on to markup and margin. So this is where the lesson sort of splits. So again, we're sort of snowballing this at the moment, trying to see how it goes with the two units together. So I know some people may not be on final accounts yet. However, we're trying to keep the content sort of interlinked and then working sort of alongside next week, and so on and so forth. So there's sort of a linear pattern to it, and we aren't just mishmashing, I think might be a one term to use. So for markup and margin, so essentially we're talking about what's called cost structures. In the terms of your final accounts prep exam, these are expressed in the forms of either markup or margin. So essentially what you will do with these is use these structure methods to highlight incomplete records, which is an important part of final accounts prep. Incomplete records is something which will almost guaranteed come up in your exam. Very, very important that we have really good knowledge of it. So we're going to look at markup first. And again, I think we'll find this, hopefully people have seen this before. We're sort of going to revisit, reinforce it. And again, I know some people are on advanced bookkeeping. So like I said, we're trying to trial something here. So your feedback is of course welcome. So when we're looking at markup, we are essentially adding a percentage to our overall costs to determine a selling price. So a useful tip is to remember that we are putting our mark up on 100%. And to give you guys a visual expression of that, this is the last little bar that we like to use. So fundamentally, when you see markup and margin side by side, you'll sort of see how this links together. So you can see that we've got our overall cost of 100%, and then we are putting our mark up on top of that. So for this example, we're just using the figure of 20%. And to sort of point out the obvious, if we are combining these two together, we are of course looking at 120% between the two. Now, the reason we express it like that, because like I said, when you come to see margin, you'll see how the two methods differ. So when you are presented with these questions, be it markup or margin, you are essentially doing one of two things. You are either going to be calculating a cost of sales figure using the value of sales figure that you will be given, or vice versa. You will be told, this is our value of sales figure. This is our cost of sales figure. Can you calculate the value of sales? That is fundamentally what we're doing. Some people really get sort of bogged down by markup and margin, but this is all you will ever be asked, one of two methods. So again, for the sake of these examples, we're going to say our markup is 20%. So fundamentally, these are the only two calculations that we need to remember in terms of markup. So if we are working to find out our value of sales, we will be given the cost of sales figure. We will divide that by 100. We will times it by 120. Now that figure is of course 100 alongside our markup, which is 20%. So for the sake of clarity, if our markup was 25%, we would be timesing by 125 and so on. That will give us the value of sales. Okay, and let's flip it. If we want to work out what our cost of sales is, we're going to do the same calculation, but swap around the multiplication. So we'll be given the sales figure. We will divide that by 120. We'll then multiply that by 100. That is it. Markup and margin is something which causes so many headaches for people, but those are the only two calculations you will be expected to perform. You'll see how that ties in with incomplete records next week. But for the moment, we want to focus on making sure we can nail these calculations. So let's move on to margin. So margin is when our profit is included in the overall selling price of the goods. Now, a good term which I like to use is margin included. Again, just to differentiate between the two, we have our mark up on costs. We have our margin included in the costs. So as you can see here, I've got our costs of 80%. And then within that, we have our margin of profit, which is 20%. And then again, to state the obvious, the key differentiation between the two is in this instance, instead of putting our markup, it is included in the 100%. And again, that is it. On the surface, looks relatively straightforward, but we're going to throw up a couple of questions before we wrap up just to see how we cope with it. And again, when applying margin, we are going to be asked the exact same thing. So again, we will be given a sales figure. We need to calculate the cost of sales, or we are given a cost of sales figure, calculate the value of sales. And you'll see when we look at the example, there is an incredible similarity in terms of the question. The only difference is, as you're saying, because we're working in margin, we're not working on, for example, 120%, because our figure is included, we're now working 80, as you can see there. So for cost of sales, we're going to divide that by 80, times it by 100. That will provide us with our value of sales. And then let's flip it. To calculate our cost of sales, we're going to take the sales figure, divide it by 100, and multiply that by 80. So in essence, to nail markup and margin, to strip it back to its bare bones and sort of cut through all the chit chat, there are 4 calculations that you need to memorize. That is it. It doesn't get any scarier than that. Its bark is a lot worse than its bite in my experience. If you can nail these 4 questions, when you expand on this and move into incomplete records, you will have this bit nailed. And once you know this, it makes the rest of it an awful lot easier. So I'm very quickly going to pull some questions up, if my screen will let me. Okay, so let's have a look. Markup and margin. So let's say we got, again, it's going to be interesting to see how you guys do with this. I know some of you aren't on final accounts yet, but let's just see how people get on. And again, it's one of those, as it's a recorded session, after it goes out, you can save it for future use. So in this question, we've been told a business has a profit margin of 20%. Its sales for the year were £132,000 gross. It made a gross profit of, it had a cost of sales of. Now, just to forewarn you guys, in this question, we first need to remove the VAT element. A very common mistake. I'm going to sort of warn you guys now, because I know not everybody is sort of covering this. So we need to remove the VAT element of that £132,000, and then we can have a go at calculating our markup or margin, depending on what the question is asking. So I'm going to give it a minute. If somebody wants to have a go, it's going to be curious to see if nobody has a go. Perhaps nobody's actually here on final accounts, and we'll perhaps just take that into consideration. But if anybody is doing it, please feel free to have a go. I'll give you a minute, and let's see if anybody has a go. Can you put the markup on the screen after to show the calculations? Yes, of course I can, Jill. I'll see if I can get those up at the same time for you guys, just so we can all see it for the essence of clarity, shall we? Can we squeeze that on screen? Okay, so it's going to be a bit cramped. Okay, so we'll take a look at the answers. So by the looks of it, again, I think we've got a few more advanced bookkeepers than final accounts. I will take perhaps a quick vote at the end just to see, because if it serves, it's going to serve people a lot better. Of course, we'll focus on advanced bookkeeping and perhaps have to just revise the overall revision schedule. So in this instance, I can see that we've got Sarah and Laura who've got it right, so congratulations. So let's have a quick run through it for everybody else. So again, we've got £132,000. We've been told that this is our gross figure. So first, the thing we need to do is strip the VAT element off that. Now again, depending on the method that you use, you know, you might do divided by 120 times by 100, whatever method works for you is absolutely fine. But once we've done that and stripped away the VAT element, we will be left with a figure of £110,000. Now, in this instance, we've been told that the sales for the year were £132,000 gross. So we're going to use £110,000. We're going to divide it by 100, then times by 80. That will give us a figure of £88,000 for the cost of sales. Apologies, Jill. I will pull the other screen up very quickly. And like I said, this is being recorded, so you will be able to have a look at it there as well. So we'll have £88,000 as our cost of sales. And then simply at that point, we evaluate that against our figure of £110,000, which gives us a profit of £22,000. So if people haven't seen this before, again, it will probably sound like a lot of waffle, but just stick with it. And then let's have a quick look. I'm just conscious of the time, so I'm going to leave B, because what I'd like to do instead, guys, is just ask you, what unit are you guys sitting at the moment? Like I said, the original plan was to have this as a bit of a hybrid between the two units. If there's an overwhelming majority on advanced bookkeeping, it is obviously going to be a bit more prudent split between the two. There might be a synoptic in there as well. ABBK, ABBK, a couple of synoptics, Carolyn exam tomorrow, synoptic, synoptic, synoptic. Okay, interesting. Okay, so I guess the next question, guys, is, again, we do appreciate your feedback. Would you prefer to have these sort of sessions together, so we have a snippet of final accounts along with the advanced bookkeeping, or would you prefer these to be separate? And obviously this, I'm curious to see what the people that have sat the synoptic sort of think about that primarily. Do you guys prefer it when you've got a bit of both squeezed into one, or do you prefer it when you have the units completely separate? We said advanced bookkeeping starting second lesson of final accounts. Okay, a bit of a mix, like both. That's we've got the duality there, haven't we? Prefer them to be separate. I like both. I'm not bothered. Separate. Okay, that's fine. That's fine. Thank you for your feedback. We will, we'll perhaps just have a look at it. I can appreciate, we're trying something a little bit different just to see how overall effective it is. I will perhaps mention it. And like I said, because yes, these are free revision sessions, but obviously we want to make sure that these are, as good as they can be for you guys. So I know that we are doing one of these on level 2. So I'm going to mention that to the level 2 tutor that's done that today, see what they thought about it as well, and then we'll sort of pool our thoughts together. So just to wrap up, I'm conscious of the time now. It's sort of just flown by. So I'm just going to very quickly get the schedule up for you guys. Please can. Computer, there we go. Okay, so this was the original schedule. Now, like I said, based off this feedback, we might just go back to the drawing board, just see if we might ever so slightly refine this. But like I said, these sessions are going to be split between 2. So you've got myself, and then you've got another tutor, Ian Wild, who will be taking them, and we're going to sort of doing these in alternating weeks. But the plan is to have these sort of run in a linear fashion. So, for example, we've got depreciation, and then obviously leading into that, we've got disposals, and then, for example, we've had markup and margin, and then, of course, sort of concurrently tying that in with incomplete records. So this is the originally planned schedule. We'll perhaps just have a rethink about this based off the feedback, and just sort of weigh it up. So thank you for your feedback. I will sort of relay it to the other tutor, like I said, and see what they have thoughts on it. So I am going to wrap it up there, because I am conscious that we've overrun by 5 minutes, and I don't want to keep people waiting on a Monday evening. So I'd just like to say thank you for your patience with the technology. It gets more advanced every day, but it always seems to go wrong at the moments you really want it to. So thank you for your patience with the audio issues. And like I said, thank you for your feedback. with the sort of like the running order. We'll have a think about it, and obviously either way, you know, I hope to see you next week where Ian will be taking over. He's a fantastic tutor. You know, I think you'll really enjoy his input and his insight. And then, yeah, enjoy the rest of your evening, guys, and I hope you have a lovely rest of the week. So take care. Thank you.